Hi everyone, welcome back to the podcast. I have Keshav with me. We had an interesting discussion and debate, me, Keshav and Alban, which was revolving around face value and dividend yield and dividend ratio and dividend payout percentage. So as an investor, all these numbers can be interpreted in different ways by different people depending on what they want to use the number to sell to you and why you have to be cautious to understand these numbers differently and how they work with each other is important, so you don't get fooled into thinking something is there when it's not there.
In one of our previous video, we talked about face value and we told dividend is actually calculated by the face value. And today morning you said that dividend is not calculated by face value, it is calculated by EPS. You said, I said no sir, it is calculated by dividend because the most of the places I studied, it shows only face value. With using the face value, they are calculating the dividend. I said, then you introduce me a new term, sir, like dividend yield and dividend payout. Two of those things.
Three things. Let me break it down. Simplify. Okay. You have dividend.
Yes,
okay.
Sir.
Then you have the dividend yield.
Yes, sir.
And you have the dividend payout ratio.
Correct, sir.
Okay. Payout percentage. So dividend is declared by the company.
Yes, sir.
And there, what the company does is, when they declare, they tell you in a percentage.
Yes, sir.
And that percentage is calculated by the face value because as far as the company is concerned, it doesn't care about the market price.
Okay, sir.
Okay? As far as the company is internally concerned in their books, their price of per share is the face value.
Okay, sir.
Okay, let me break it down so you understand. So inside, it's like inside Keshav's medical company, whatever you have decided is the share price, is the
share price.
Yeah, that's the face
value. Okay.
So that is 10.
Okay.
So when you declare a dividend, let's say 40 rupees, you calculate the percentage saying, okay, I'm giving 40 rupees for every 10 rupees because the price is the face value.
Okay.
So you'll say I'm declaring a dividend of 400%.
Understood, sir.
Okay, that is what the company is declaring.
Okay, sir.
And that number is useless.
Okay, sir.
You're right. It is used to calculate face value.
Face value.
Technically. But as an investor, that number is useless because that's like a marketing number.
Understood,
you see, Bata price, 9 rupees 99 paise. It's 10 rupees. But just to hook you, they'll say 9 rupees 99. You cannot go ask for 1 paise.
Correct, sir.
You don't give 10 rupees and give me 1 paise. They'll laugh at you.
Correct.
So same way, that number we don't need to consider. The numbers you should mainly focus on is the dividend yield and the dividend payout
ratio.
Yeah. And the dividend yield, like the PE, is calculated on the current market price.
Okay, sir.
Because you're not paying the face value when you're buying the share now.
Correct, sir.
You're paying whatever the market is asking you to pay.
Yes,
so
sir.
you have to see your dividend payout based on the
market price.
Yeah. So that is the yield.
Okay, sir. Done.
So that way, let's say that case of medical store, the price you're paying 40 rupees dividend, right? But each share is selling at 400.
Okay.
Then the ratio is what? Instead of 400% dividend, the actual dividend is 40 divided by 400.
Yes, sir.
Which is what?
10, sir.
10%.
10%.
Correct. So now you imagine from 400% you come down to 10%.
10%. Understood.
That is the yield.
Yield. Okay.
Now one step further.
Dividend payout.
That is also you should not, as a value investor, look at.
Okay, sir.
What you have to look out is the dividend payout. Dividend payout is a percentage of the earnings.
Okay.
It's got nothing to do with the face value.
Okay, sir.
Nothing to do with the market price. Because as a value investor, you don't care about market price.
Yes, sir.
Of course, it has to be value in it, but you don't focus on that. You have to focus for every rupee you put, how much are you going to get back?
Yes, sir.
And that is based on the dividend payout percentage, which is on the EPS, which is actual earnings of the company.
Okay, sir. Done.
Understood?
Understood, sir.
So that is on the EPS. So let's say a company has an earnings of 3 rupees.
Okay, sir.
Right? 3.38 rupees. And the dividend payout is 31%. So then what you do is you get 31% out of 3.38 rupees. That is the actual
dividend payout ratio.
Yeah, that's the dividend payout, what they're paying you for dividend.
Okay.
So let's do a calculation.
Sir, and I want to...
One second. Let me just clarify.
Yes, sir. Yes, sir. For that only I'm asking that today morning you gave me an easy max thing, sir. Like you can also tell the audience. That will be useful for them, sir.
I think most people will know that. That's only hack for you, man.
Yes, sir.
Whenever there's a percentage, when you multiply it, instead of using the percentage calculator, I convert the percentage into a decimal.
Okay.
So with 18%, that's 0.18. With
correct,
1%, it's 0.01. So you multiply it by the decimal instead of the percentage button, because in your calculator, if you do not know what you're doing with the percentage button, you'll get it wrong.
Correct, sir. So that
if you're
we
not
can use
used to
this.
it, you can get it wrong.
Use this method.
Yeah, so the simple method is to convert it to a decimal. So
Okay, sir,
when we convert 31%, it's 0.31. So 3.38 times 0.31. So you're going to get a dividend of 1 rupee. For every 1 share, you'll get 1 rupee.
1 rupees. Correct, sir.
Right, that's what they paid. So then you look at the company price. If the company is trading at 10 rupees today and they're paying 1 rupee every, so that means they're giving you 10% of your money.
Correct,
every
sir.
10 rupees you're putting, they're giving you 1 rupee for every year. So that's good as an FD.
Correct.
So instead of putting your money in an FD,
you can
put it in this. So if the company share price grows, there's growth in it.
The dividend also.
Dividend grows. If it grows or not, your money is secure.
Correct.
You're getting like a dividend. This is the main reason why Anand was considering that Indian Railway stock.
Okay.
He was considering that because at 20 rupees, it was paying you 2 rupees every month. Every year. So that's 10%.
10% off.
Yeah. So it looks attractive. It's government. It's like having a government bank FD. Right. Now that price has gone to 170 rupees. But the dividend payout is still the same. So the percentage, if you see the dividend yield, because the share price has gone up, the yield is plummeted. So the yield would have been at 20 rupees and 2 rupees, the dividend yield would have been 20. Now it'll be in decimals. It'll be like 0.08%. From 20%, it's dropped. Not because the amount of dividend they're paying has dropped. It's because the price of the share is
increased. Understood, sir. Sir, but when I searched about this face value and all, I went to so many websites and I saw so many videos and all. In all those videos, they are referring only to face value, sir.
That's
I don't know why they are.
Purely in terms of accounts. You would have seen videos as an accountant. If you're running as an accountant, you're auditing your book.
Okay.
It's correct. Because you, as a company, internally, as Keshav, you're running Keshav Medical, so internally, you don't care about market price. The company doesn't care about market price.
Correct.
The company only works on its accounts books. To be profit and everything is based on its accounts.
Yes, sir.
The market price is what happens outside the company. So when you're talking about face value, that is only a reflection within the company.
Inside the company. Correct.
So as an investor, you have to keep all this in mind.
Understood, sir.
So I hope this gave you clarity.
Yes, sir.
Because I was worried in the previous video when we spoke, we did not talk about this in greater analysis. We didn't see the different. I just broadly spoke and I said yes.
Yes, sir.
But I was worried people might make a fundamental mistake like this when they look at it, thinking face value, if they're saying, 30% dividend, that means on face value, 3 rupees. There's a difference in it.
Yes, sir.
Who's saying it is important. Who's giving you the information is important. Understood. Where are you getting that information? As a value investor, what you want to know is the dividend payout percentage. Once you know the dividend payout percentage, you know the EPS, right?
Yes, sir.
And you know the share price. You see how much you're going to get for the money you put in.
Understood, sir. Sir,
dividend payout is important.
Is the dividend yield is calculated only at an early basis, sir? Or
it's calculated as a price fluctuates. Like P, you can calculate P
daily.
Every minute, you can calculate every second. Because prices, when the market is trading, prices moving up and down. So you can calculate as much as you want.
Understood, sir.
Don't do too much calculation.
Okay, sir.
Okay.
Can get into mess. Understood.
So we look at long-term projections, how it's going over a long period of time, and if it all looks good, then it's great.
Okay, sir.
So one strategy is dividend strategy, where you get monthly yearly dividend from a company. So if you put so many lakhs of rupees in it, you'll get so many thousand rupees dividend every year. So it's called dividend investing. So you get steady stream of income, like bonds, like bond interest. So this is a strategy. In that dividend investing strategy, you have to pay attention to dividend payout.
Understood. Right? Sir. Yes, sir.
Chalo. Thanks for watching the podcast, guys. I hope you also got some clarification in this. Do send us your questions if you have further clarifications or any other query regarding this. We'll try our best to explain it in an easy manner. Thank you.
Thank you.